Hey guys, welcome back. In today's topic, we're going to be looking at property insurance and why you need property insurance to protect your assets and what are the key differences between MRTA and MLTA. And at the later part of the session, we're going to be looking at some of the strategies that you can employ in your property portfolio right now. So let's get started. So getting a home, it's a really good thing. It's good to start at a very young age. But the problem is, what can happen is if something happens to you, in the event that something happens to you, in the event of death or disability, or if you lose the potential to earn an income, now what's going to happen to that loan that you're supposed to pay off in the next 20 to 30 years? So that's where insurance comes in. So insurance comes in so that in the event that you are not able to repay the loan, it can help you and support that income. So in Malaysia, we have two kinds of products right now in the market. One is MRTA and another one is MLTA. So both are basically products to help you in the event that you are not able to pay off the loan in the event of death or disability. So what are the key differences between MRTA and MLTA? So let's take a look. MRTA offers protection from death, but there is no protection from total permanent disability (TPD) or critical illnesses, and there is also no additional cash value. But if you look at MLTA offers protection for TPD, critical illnesses, and there is also cash value. So what the cash value means here is, for example, if you took up a loan for, let's just say 30 years for 500k, and after 15 years you have paid up about 300k. In the event that you die during that 15 years, there is a balance of 200k. So that 200k is guaranteed as cash value to your beneficiary. So that's the meaning of cash value. And for the sum assured, for MRTA, it will reduce over time. So for example, from 30 years up till the end of the tenure, it will keep on reducing to a certain level. And at the end of the term, it will go down to zero. But for MLTA, the protection is constant throughout the tenure for 20 years or 30 years. So in the case of MRTA, in certain instances, right, because you did not take a full term of 30 years or 35 years, in some cases you may actually need to top up the differential amount. So let's just say if your loan is 500k and after 15 years, there is still a pending amount of 50 to 100k that you will still need to top up, which is not covered by the MRTA. And in the case for transferability, right, for MRTA, it cannot be transferred to another property. So the MRTA only applies to that property that you bought it for. But for MLTA, you can easily make the transfer between property A and property B. So that's the kind of flexibility that you get with MLTA. And for the beneficiary for MRTA is always the bank. The banks will always get paid first. But for MLTA, the beneficiary can be nominated, so you can set the nominee as your family, your spouse, or the trustee. So if you recall earlier, when I said that in certain cases for MRTA, you may actually need to top up an extra amount to pay off the loan, right? So if you took MRTA and there is still a pending amount which has not been settled, the title will still be held by the bank. So you need to pay off that differential amount, and then only the title deed of the property will be surrendered to your family or the beneficiary. For the financing and payment, for MRTA, usually it will be financed into your home loan. So you can make the lump sum payment and it will be absorbed into your full home loan. And for MLTA, most of the time it's self-finance, or if you're taking it from the same bank that is offering the mortgage loan, it can be absorbed into your loan amount. Or you can opt for quarterly, annually or monthly payments. So you need to discuss that with the bank officer. For the cash value, MRTA, there is no cash value because the sum protected will be reducing based on the term, and for MLTA, there is a guaranteed cash value upon the end of the tenure. For the claim, the insurance company will make the payment to the bank, and then the beneficiary will receive the home. For MLTA, the beneficiaries will receive the home plus the cash value. So that is the advantage of MLTA. So from what we have just saw earlier, what we just discussed, you can see that MLTA hands down offers the most comprehensive protection. So the question comes down to how much would it cost to take MLTA and MRTA? So if you look at MLTA, right, in certain cases, it can be 2 or 3 times worth the amount compared to MRTA. So in that case, because of the flexibility and comprehensiveness of the protection, right, MLTA is very costly. The premium is absolutely very high. In some cases, right, MLTA can actually cost up till 10 to 15% of the property amount that you're buying. So for example, if you're buying a $1 million property, it can cost up till 100 to 150k just for the insurance protection. So you can see MLTA is absolutely very expensive. So which kind of product should you take? Should you take MLTA or MRTA? So it all really depends on what is your priorities right now. What are the biggest concern that you are having? If you think that it's really important for you to have full on coverage, full protection, then by all means go for MLTA, because you can do the transfers easily. The nomination goes to your family, okay. But if you think that you're really on a shoestring budget, then just go for MRTA because it's way cheaper compared to MLTA. So let's take a look at some of the insurance strategy that you can employ in your portfolio right now. So depending on the kind of properties that you are holding right now, whether it's for own stay or if you recently bought a property for long term, above, if you're planning to hold it for 10 to 20 years, or if it's just for short term, if you know that you're going to exit in the next 7 to 10 years. So we look at some of the strategies that are employed by investors all around, okay. It's not right for everybody, but then again, it depends on your current priorities. So for example, if it's your own stay property and you took the loan for 30 years, then you need to take the MRTA up till 30 years so that it can protect you for the 30 years. But if you know that the property is for investment, you're holding it for the next 15 to 20 years, then you can opt to take the MRTA for a lesser term. So maybe 15 years or 20 years. But if it's for short term, okay, you can take it for maybe 10 years. But as you can see, with that strategy, there is a certain limitation or downfall, because if you don't take the full term of the MRTA, okay, and in the event that you pass on in the next 5 years before the term of the MRTA, your loan is fully paid up, so then your family member would have to top up the remainder amount. So to prevent that, right, to counter that, what investors usually do is they will have adequate life insurance. So you can see that most investors, if they have 4 or more properties, their life insurance coverage will usually be very high. So they'll be paying a very high premium. So this is to protect themselves in the event the MRTA is insufficient to cover the property loans that they have. So that is one way that you can protect yourself adequately. Okay, but it's not the right strategy for all. It really depends again on what is your priorities, what are your portfolio, what are your objectives, okay, in the property investment game. So there you have it. That's the difference between MRTA and MLTA. I hope it clears the air and you fully understand the difference now between these two products. Now, just a disclaimer, this is generally what's available on the market, but in the recent years, there has been many hybrids available, okay, between MRTA and MLTAs. So to really get a clear understanding of what you need, it's best that you speak to one of the insurance guys who are more adequate, more professional in dealing with this kind of products. So I hope you guys have enjoyed this. Do remember to subscribe, comment and like and share it with your friends and families.